You need a trend following tool, a tool that's going to keep you ultimately with the consensus view of the market. When you're reading the newspaper and you believe perhaps there's a new narrative forming, you need to confirm that narrative with price validity. Now, I'm going to give you a very simple tool, very, very basic tool. You're going to look at it and go, it can't be that simple. But the reality is it is that simple because it does something very intentionally. Now, I'm going to show you the tool. I'm going to explain the tool to you. And then what I'm going to do is I'm going to take you through 5 markets. So we're going to explore it across 5 markets. And we're going to talk about how this tool shapes and interprets the trend for us. We're also going to talk about the pattern that we can lean on, that we can actually execute longer term swing trades. Okay. Very, very important. This is a tool that you look at once a week. You don't need to be sucked into viewing this every day. It's not a 1-minute chart. Okay, it is a very, very long-term trending type tool. So let me explain it on the blackboard. You're going to get a chart up. And what you're going to do is you're going to put 2 moving averages on it. The first moving average, I'm going to annotate in a green line. And that is, let's say, a 50-day simple moving average, SMA. Okay, and this is effectively our long-term trend line. This effectively gets rid of all the noise and it just smooths out and showcases to us the trend in price. We're then going to add a second moving average to it, and that is a 5-day moving average. And we're simply going to go and plot the two together. Okay. Now, what you're going to see ultimately, and I'll show you a number of examples of this, is you're going to see a number of things, but there are 3 key things I want you to pay attention to. Okay. Number 1 is there a trend? So number 1, is there a trend ultimately in the 2 lines moving together? Okay. Is there a trend or is there no trend? And we determine this by the degree of crossover. In other words, if, for example, we see something like this, where the red line is just constantly crossing over the green line, there's no trend in this market. And this is effectively a market that struggles with any kind of fundamental drivers. It's simply just being driven by short-term noise. Okay. If, however, we saw something, for example, where we saw a very nice, neat trend, like I can show you, like you can see on your screen now, that is a very nice trending story. That is a trending market that we want to pay attention to. Okay. The second thing I want you to pay attention to is the degree of steepness. Okay, is it steep or is it flat? Okay, because the steeper it is, the stronger the story, the stronger the initiative being taken by participants in the market. The shallower, yes, sure, it's being driven by a fundamental, but it's not as strong. In other words, there's not that much impulse to get within this trend, to get onto this trend. Okay, so the degree of steepness matters a lot. And then finally, the spread between the 2 lines. Okay, and this is very, very important. The distance between that line and that line matters because we use it when determining if this trend is now currently overbought or if it's more fair value. Okay, so when the line comes back to the longer term moving average, we're closer to fair value. When we're very far away from it, we're in more overbought territory. Obviously, I'm showing an example of it going up. If it was going down, it would be oversold territory. Okay, so the distance between the 2 lines matters because the further away we get between these 2 lines, the wider the spread goes, the higher the probability becomes that we are going to have some form of consolidation. In other words, sideways movement. The trend ultimately, the longer term curve needs to catch up ultimately. Okay, I'm going to show you a number of examples. Now, before I get to it, why do we use 5-day and 50-day? Okay, the short answer is because a 5-day smooths out all the short-term price volatility. It's 1 week. In other words, it's effectively just the weekly price change on average. Okay, now that makes sense for me. Week by week, 52 weeks in a year, it makes sense. Okay, if we then look at the 50-day, why the 50-day? Well, because it's 10 times that number and because people look at the 50-day as a trending tool. Okay, so there's a lot of participation that people believe in the 50-day moving average as a really good medium-term trending type technical indicator. Okay, so that's why it's the 5-day and the 50-day. The point is that the 5-day ultimately, it's short enough that it can show me when there's something new in the market, something that's driving price, but it's long enough that it doesn't oscillate too much and create a lot of noise for me. equally, the 50-day is short enough that it doesn't move so slowly that I don't even hop on the trend, but it's fast enough that ultimately it can react and not be too slow ultimately to catching up. Okay, so it's a nice balance for 5-day, 50-day, and that's why I use it. Okay, now let's look at a number of examples. Now, how you need to think about this, like I said, three things: steep curve, flat curve. Is there a lot of overlap? And what's the spread? Those are the three key things you're paying attention to, okay? Now, what I want to start with is we're going to talk about the oil market because what we've seen in the last 2 years is perhaps some trending post-COVID and then absolutely nothing, okay? Now, if we go back to COVID era, you'll remember that was when oil went negative. And at the end of 2020, of course, we had all the central banks pumping significant amounts of stimulus. And eventually the world started to open up. Okay, we realized that it wasn't the end of the world. And we started to see a significant amount of demand come back online. Okay, and it was at that point in late 2020 that we started to see a new narrative form. Okay, think of China growing. Right? Think of the rest of the world suddenly having a significant amount of demand because everything's opening up all at the same time. Okay. As a result of that, you can see that our fast moving average in red very quickly moved away from our slow moving average in blue. Okay. Moreover, this narrative or this trend held. You can see we came back to retest it and continued higher. We then went sideways. Okay, so we then found a period of sideways trading for quite some time. Okay, for almost 6 months, the market oscillated on both sides of that longer term average. Okay, and yes, sure, that trend was very much intact, but this is a period in which the market now needed to just consolidate around this new normal of oil prices between 64 and 68. Okay, now one thing you'll notice is I don't even have a price of oil on this chart. Why? Because it doesn't tell me anything about the trend. It just creates a lot of confusion and noise, right? These are just simply two moving averages. We then had a continuation of that trend in late Q4 2021. And what was that driven by? Well, the reopening of China. There was a lot of positivity around China. There was a lot of positivity around the world. Central banks were willing to keep interest rates low. None of them wanted to hike. Everything was coming back online. And suddenly, again, we saw a reignition of that trend. Okay, and a lot of volatility and a significant spread ultimately between the 5-day and the 50-day. Okay, now when you get these very significant spreads, a significant overbought territory, that does not mean you sell it, but it does mean the probability of us finding the end of this trend is getting closer. Okay, particularly when you get very wide spreads after a trending move. Okay, so you can see we had a very strong trend up in oil for a good 2 years. We then get this blowout area between the spread. That typically is how markets top and bottom. That's how trends end. They end in this explosive volatile move. Okay, as a result of that, we can then fast forward, of course, to late 2022. If you cast your mind back, that's when the entire world was coming to an end because central banks said we need to start hiking and we need to hike a lot. Think 75 basis points. And that's when there was demand destruction. And that's when the stock market corrected 20%. And that's when everything corrected, including the price of oil. Okay. Moreover, note the V-shape reversal. Why did that happen? Because the entire market was on a trend for 2.5 years. The entire market was positioned long, caught wrong-footed, and that positioning came unstuck. And that's why the degree of the reversal was so significant. Okay. But then we obviously found our way into some sort of a range. And you can see that for the last 18 months, effectively, oil has done nothing. It's trendless. There is no narrative. And sure, at the start of this year, there was some hope that China was doing better and oil prices went up. And then China stopped doing so well, and then oil prices went down, and then hedge funds were super long, and then geopolitical risks and Middle East risks. But what's the price of oil done? Absolutely nothing. Okay, there is no fundamental driver in this market. There hasn't been one, and perhaps there won't be one for some time more. Now, why does this matter? Because we definitely don't want to be selling it there and buying it there because there is no trend in this market. Now, sure, at some point that might change. At some point, suddenly, maybe we get China coming back online and significantly demanding. Maybe the US starts growing at 4.5% next year. Okay, maybe OPEC opens up the valves and starts pumping significant amounts of oil and says, I don't care. Saudi Arabia says, I don't care. I'm just going to pump. In which case, fine. We get a new narrative forming and we get a new trend forming. Okay, that's the oil. Let's look at another market. We've got gold. Okay, a fabulous market. Tells some fun stories. And what we can see is late 2018, that was the Powell pivot. That was when Powell came out and said, look, we're going to stop hiking. We need to start cutting. And at that point in time, he did it because the NASDAQ was down 20%. But US GDP was still above average. It was still around 2.3%. And so the market said, well, hang on a sec. He's effectively putting a put in the market where he's not willing to let stocks go lower. At the same time, there was this concern that because he was cutting rates at a time when inflation was not moving lower and growth was not problematic, there was a concern that he was going to create unwanted inflation expectations. Okay, and that is what led to the initial rally in early 2019. We then had consolidation. Nothing happened for a period of 6 months. And then we have this sort of erratic behavior. Sure, gold's gone up and it's trended higher, but this is not a clear trend that took place in late Q19 and Q20. Okay, the last part of it, sure, absolute sense, COVID. Okay, we had COVID in the market. There was uncertainty. The dollar got hit very, very hard. There was balance sheet expansion. So fine, that last move is very explainable. But the reality is, up until that point, there was not much trend in gold. There was not a strong enough trend or strong enough narrative to drive the price of gold. And then, what did we see for a period of 2 years? Absolutely nothing. Yes, we had some short-term stories. Yes, we had some pivoting up and down and up and down and up and down. That was a weak narrative. Fast forward to, of course, late 23 to early 24. What happened? Well, suddenly, Powell pivoted in December. He said rate cuts are incoming. The market had priced in 7 cuts, and gold ultimately took off. Okay. In Q1 of this year, we had the inflation blip where the central bank told us they're not worried about inflation and they're prioritizing ultimately the labor market because they see the disinflationary process as being intact and they're willing to allow inflation to come back to their target in a couple of years' time. That's what they told the market. And the market said, hang on a sec, that's a new story. That's something we want to get a hold of. Right? Not only that, but the markets never let go of that story. In other words, this is a strong narrative that's driving the story in gold. Now, in a minute, I'm going to show you ultimately how these stories play out with a very baseline illustration. But I want you to think of gold. I want you to think of weak narrative, strong narrative. And in a moment, I'm going to show you the pattern play that starts to exist within any trend, whether it's an up or a down trend. Another example, US bonds, because this is a fantastic one. Okay, bonds are driven ultimately by the story of real rates, by the story of inflation expectations. Okay, particularly the ZN. And what was that driven by? In late 2021, Powell came out and said to the Senate, no, we're not going to hike rates because we think inflation is transitory. Where did inflation get to in the US? 8.5%, PCE, 7.5%. Okay, so he was late. He made a mistake. He made an error. And the market said, well, hang on a sec. You're not going to hike rates quick enough. Therefore, inflation expectation is going to rise. And we suddenly had a significantly strong narrative, a new narrative. And we can see how wide that gap got between the 5-day, 50-day. Moreover, where was our easy entries on the retest of it? Eventually, the market had priced in ultimately not just higher inflation, but also the fact that the Fed had now begun the process of hiking. We then fast forward, it wasn't enough. We started to see inflation moving higher, despite the fact that the Fed had started with smaller rate hikes. Then all of a sudden, when inflation expectations started taking off, what did the Fed say? 75 basis points. Okay, and that's ultimately when we got a continuation of the trend, when they pivoted towards a more aggressive hawkish policy stance. But once that was priced, what did 10 years do? Absolutely nothing. No trend, no narrative. The story's told, the story's priced. Right? We fast forward ultimately to late 2023. Early 2023. Don't forget, Chairman Powell told us they were going to hike 2 more times in May of 2023 because inflation was not coming down as quick as possible. And again, that continued that narrative. This idea that the Fed needed to do more ultimately to get ahead of things is what kept driving the ZN and bonds in general. Right? Ever since then, we've started to see some pivoting. Okay, so we started to see this idea of narrative pivoting. Late 2023, the market started pricing in recession. Okay, I'm just going to do this in a different color. Green's not a good idea. Let's get blue. Okay, so in this area here, late 2023, we had 7 cuts priced. We got to the start of this year and the market priced out those cuts. Okay, we then got to, of course, May, June, July. The US economy started to slow, the labor market started to slow, and then the market started pricing in cuts again. And now the market had 1 good non-farm payrolls, and it's moving the other way. In other words, it's got this narrative pivoting that's going on, and that's why the market's moving into a trendless-like fashion. There is no trend in this market right now. Okay. Now, let's just revisit it. A number of questions you want to ask yourself. Number one, is there a trend or not? Is it moving in one direction or is it moving sideways? That's the first thing. Okay. If there's a lot of crossover between the two, you've got no trend. You've just got a very, very noisy market that's oscillating around unchanged. Okay. Number two, how steep is that trend? Is it like that? Like the gold, straight up 33%? Or is it kind of like that? There are two different things. This one is the kind of trend you want to be getting on. This is the one that's likely to continue for a lot longer than you think. This is the one that first pullbacks you need to be on because they're going to pay you the most. This one you have to be careful of. You're likely to have deeper setbacks. Why? Because everyone ultimately sees the trend, but no one wants to pay up higher prices. They're all going to wait for that deeper pullback. Okay. Whereas the steeper trend, everyone's desperate to provide liquidity. They all want to get in and they don't mind getting in at more aggressive prices because they recognize the strength of the trend. Okay. So note the difference. Steeper, you need to be more aggressive on entries. Flatter, you can expect that the short-term average goes across the long-term average, but ultimately the trend remains intact. Okay. And then finally, the degree or the distance between the 5-day and the 50-day. The wider, the more overbought or oversold, and ultimately the higher the probability is at some point you're going to have a correction. Okay. What that means is when there's a very wide gap, it's probably time for me to not just exit that trend, but perhaps sit on my hands and stop being willing to buy the trend because perhaps it's a bit overbought. That's all it is. Okay, when a market's overbought, we don't really want to be aggressively buying it. We don't mind buying it on a pullback, but we don't want to be aggressively buying it. Okay. And then, of course, finally, whenever you see these movements in these 5-day, 50-day, you have to understand the story. What is the story that's driving it? And the reason we want to understand and interpret the story is because the stories repeat themselves over and over and over again. If you learn to analyze the trend, learn to interpret what created the trend, you will see that trend playing out again in the future. And that's when you can capitalize because you're familiar with ultimately what created the trend in the first place. Okay. Now, the pattern play, how you have to think of this. Okay. And again, by the way, this can be applied to a 60-minute chart if you want. It can be applied. The logic is all the same. Trend is trend. Okay. But it works better the longer term you go out because it shows mass participation from big time frame participants. Okay. But how you have to think about this is a number of cycles. We have early cycles and we have late cycles. All right. When there's a new story, ultimately everyone wants to hop on. Think of late 2021 when Nvidia could do no wrong. Microsoft invested heavily in them and AI was the future. Nvidia massively rallied up the page. That was early cycle. Fast forward to now, we're up 1,000%. Right now we're late cycle. That doesn't mean that Nvidia can't keep going up. It just means we're late cycle. The AI has already been reflected in the price, and ultimately to continue higher, we now need to see something significant happen again, a new story being told. Okay, so that's early cycle versus late cycle. Now, what typically happens? Early cycle is when you'll have the steepest trend. So your curve is steepest early in the cycle. And what then happens is the market needs to have some form of consolidation. Now, I've done this as sideways because simply all I'm trying to tell you is that over a period of 3-4 months, the price is pretty much unchanged. Okay, now sure, it does go up, but it also comes down and it goes up and it goes down. Okay, it forms some form of consolidation. And that ultimately allows the overboughtness of the market to be neutralized. Okay. Moreover, once time has caught up, once the market is caught up or the long moving average is caught up to the short moving average, at that point now, the market is ready to continue that second part of that cycle. Now, very important, you'll notice the second part of the cycle is always flatter. Why? Because everyone's bought in early on. Okay, the people buying in phase 3 or cycle 3 ultimately are new buyers. Perhaps the story is becoming a bit more embellished. Perhaps it's being improved upon. Okay, think of Nvidia, maybe their earnings growth was 6% and now it's 6.5 or 7%. Okay, that's the new buyers that hop onto the story. Okay, but the trend is slightly weaker this time around. And this is the key. As a market or trend evolves and develops over time, the trend dynamic starts to weaken until we get to such a point that we get very late cycle. Now, typically speaking, if you go and look at this and you do this analysis and you look at so many markets, what you'll notice is you don't typically get more than what I call the 1, 2, 3. You very, very seldom get more than a 1, 2, 3. And if you do, it's ultimately because the story keeps evolving over time. So you won't see this in big macro markets. Okay? I've not seen this in many futures markets where you get more than three, but perhaps in some of the stock markets, things like Nvidia, where it's a continuous, unfolding story, where the business keeps redeveloping itself. Yeah, perhaps then maybe you get more and more of these cycles. Okay, but the point remains, the longer the trend goes on, the shallower the trend will become, and the higher the probability is that we reach the end of a trend. Okay, and like I said, the most important thing is you'll see that when you get very, very sharp movements after, in other words, late cycle, and you get very sharp movements in late cycle, those typically spell out tops and bottoms in trends. Okay, let's go look at two more examples. What we're going to look at is the NASDAQ, and then we'll look at the 6E. Okay. So if we go to NASDAQ, we go to 2019, like I mentioned, that was the PAL pivot, okay? Late 2018-19, that was the PAL pivot. Keep in mind that if you look at ultimately going into the end of 2018, NASDAQ was down 20%. Okay? There was a significant sell-off. It had a combination of concerns that the Fed had overdone it. They had over-tightened. Ultimately, there wasn't sufficient liquidity reserves in the market, and there was a bit of panic, okay? Ultimately, that drove that narrative in 2018. And then, of course, we had a flip-flop. We had a pivot. And in December, Powell told us rates are going higher. In January, told us rates are going lower, okay? And in June of that year, they began the process of cutting rates, okay? The point was, such an aggressive flip in the market gave the market the story that the Fed had put in the market. Okay, the Fed would ultimately safeguard any move at any point in time and protect markets, because they did this at a time when the US economy was still growing. Okay, and that's what started and kicked off that narrative in early 2019. Right, but then you can see the market went sideways. Okay, the market wanted to see more than just a story about the Fed being willing to get involved. Okay, it's not like we got balance sheet expansion. All we got was ultimately, a Fed that stopped hiking and began gradually cutting rates. Okay. All of a sudden, when we went into 2020, I think we all know what happened. We had COVID. We had a significant sell-off, uncertainty. Okay, uncertainty is always going to unravel any narrative, any trend. It's front and center. But the result was we had a bazooka effect fired from the Fed. Okay, now if you don't know what the bazooka effect is, it's something I teach quite a lot in the central bank course in the Tradelo application. It's just when a central bank effectively cuts rates to the zero bound. It does a very aggressive quantitative easing program, and it pretty much tries to eradicate any uncertainty and volatility within the market. Okay, and that's what we saw from the Fed. And the result of it was you've got this new trend born in March, April of 2020. Okay. And we can see the length of time that the green line, the 5-day moving average, was away from that longer term moving average was significant. It was a period of 6 months. It was such a strong trend where we were effectively just consistently overbought. Okay. And for good reason. And that consistently overbought theme is so important, because the first time we finally got a bit of pullback, that is your opportunity, if you've missed this early trend, to get involved. It's not your opportunity to sit there and go, oh, it's overbought, it's done, 50% in a short space of time, I should be short. No. Trends are strong for a reason. It's because everyone wants to be on them. There is no point in bucking the trend. Go with it. Okay, so when you do have these long periods of time where the two moving averages are away from everyone, it's telling you about the strength of that trend. Strong trends typically continue. And that's what we got into 2021. And of course, then there was the AI story and the growth story. And of course, we had fiscal spending. So the US was growing at 3.5%, 4%. And so it was just a number of stories that all culminated in these two moving averages moving higher. We had very limited crossover between the two moving averages. But what you will notice in the NASDAQ is as we went through the cycles, and I'm just going to annotate them for you. As we went through the cycles over the years, you can see that's early. Now we start to mature, and now we get to late cycle, okay? And you can see in late cycle, it's not that the trend broke, but we can see that degree of pullbacks through that purple line become much deeper, okay? Yes, we had a degree of deep pullback there, okay, in the mid narrative, but ultimately as we get further along in the trend, that's when the probability of deeper retracements exist. And that's the key pattern play you want to take away from this. Okay. Moreover, if we go and look, like I said, in terms of volatility, look how the top is formed ultimately in the NASDAQ. Okay. We had a significantly wide period between the two moving averages late on in the cycle, and that was the top of the market. Okay. Sure, we had a double top, But in essence, that was the top of the market. Tops and bottoms are formed on volatility. Fast forward, end of 21, central banks got serious. They told us that inflation was a problem and they were going to hike with exceptional policy measures. In other words, 75 basis point hikes. Markets got afraid. Everyone was long the market, as we can see, and that created a great unraveling. We, of course, had a significant correction. Okay, but by late 22, what did we do? Effectively, the trend had diminished. We had started moving sideways until all of a sudden, what happened in 2023? Well, we started to see the story of US growth exceptionalism again. Okay, and this is the point where the US grows 3% every year. The UK grows 0%, Europe grows 0%, Japan grows 0%. All your G7 are not growing, but your USA is growing. Now, why they're growing is a different discussion, but ultimately they're growing. So money flows into markets that are growing. And that's what's driven this new narrative since late 2023. Of course, that's our phase one. We had our first pullback. That's our phase two. And we've now reached late narrative, phase three. Okay. How does this end? Well, typically it's going to end with a bit of volatility. So let's have a look and see what happens. Okay. We can see right now our spread is not that wide. Okay. We did have quite a wide spread in June, July this year. We've got an election coming up. I wouldn't be surprised if we do have a spike and that's it. Okay. It's very, very possible, but I'm not going to preempt it. I'm not going to sit there as a trader and going, oh, yeah, it's going to end now. It's late cycle. It's late narrative. It's going to end. Okay. Because cycles can continue for a long, long period of time. The point is I don't want to be aggressively buying it up here because the trend is very, very mature and the probability of a trend ending is much higher. Okay, finally, one more market. Euro dollar. Okay, this is a fantastic market. It's a market that I think actually has started a brand new narrative as of 2 weeks ago. And that narrative is ultimately an ECB central bank that's behind the curve, that's going to have to cut below neutral and cut back towards negative interest rates. Okay. Now, if we look at the story of euro, it's a story that's very different. It tells a very, very different story. And in general, currencies are always driven in some shape or form by differentials, okay? Real rate differentials. If I put money in the US right now, I've got a real rate differential of about 150 basis points. If I put my money in Europe right now, I've got a real rate differential of around 50 basis points. Okay, so putting my money in the US, I get 1% more than putting it in Europe. Okay, that makes owning dollar assets more attractive than European assets. Now, when those differentials widen a lot, so think of Japan. Japan currently probably has around a negative differential or a negative real rate of around 150 basis points. Okay, so ultimately the real rates in Japan are minus 150. If we look at the US, where interest rates are call it 5% or 4.75%, sorry. 4.5%. If they're at 4.5%, they've got inflation of call it 2%. They've got real rates of about 250 basis points. Okay, so there's a 400 basis point difference between dollar assets and yen assets. So I could just as well borrow in yen and invest in US assets. Okay, and that's why the Japanese yen is weak. Right? I posted a chart just a few days ago to the Tradelo traders, showing them that we are now 2.5% away from pretty much the levels that the BOJ was intervening at earlier this year. Okay, it was the very reason they began the process of hiking, because they had started running out of money, buying up and propping up their own currency. The reality is that differential still exists. And guess what? The BOJ is going to have to defend the currency again. And the only way they're going to do it is by hiking rates. Okay, but anyways, I digress. Coming back to the euro. Okay, what we noticed in 2014, this was an era when perhaps some of you weren't around, but this was when the EC began their process of QE. Okay, they started about 3 years after the Fed. And ultimately, they started at, unfortunately, a time when the Fed was almost done. Okay, and that created a significant rate differential. As a result, the early narrative is the euro dropped by 34%. Okay, but, and this is key, this story is what's informing me of what's potentially coming now, which is when you get a rate differential where one central bank is talking about zero rates for an extended period of time, the other one's talking about we need to start hiking rates. Ultimately, that creates a significant rate differential, which creates the potential for a very, very significant drop in price. Okay. Now, why do I believe that's incoming now? Well, because we're currently in an environment where the US economy is growing very rapidly still. We still have got inflation in the US, and we've got a lot of fiscal spending. Okay. And what that suggests is that the Fed is not going to be able to cut as much as they would like to. On the other hand, in Europe, we've got a central bank that's got inflation at 1.7% below target. We've got a central bank that doesn't have fiscal spending going on in Europe. And as a result of that, we've got weakening growth dynamics. In other words, Europe's in a recession and the United States is growing rapidly, right? And what that means is we're going to get a rate differential similar to what we have in Japan, where we have negative rates in Japan in order to keep things afloat, and we have very positive rates in the US. Okay, we're likely to get the same thing in Europe now, and as a result of that, euro should go back to parity in a very short space of time.